This accounting mini lecture discusses the accounting equation and account types. The accounting equation simply states that assets equal liabilities plus equity. This accounting equation will always be true. In financial accounting, our balance sheet proves that the accounting equation will always be true. Our assets will always equal the sum of our liabilities and our equity. Equity contains a few components. The first component is going to be the owner capital. Now, for a small business, such as a sole proprietorship, this would simply be the capital that is contributed by the owner. If this were a corporation, this would be the amount paid for the common stock that was issued to the shareholders. The owner withdrawals for a small business such as a sole proprietorship, these would be the withdrawals that the owner takes out of the business for their own personal use. If this were a corporation, this would be dividends, and dividends are basically the distribution of earnings to shareholders. The two other elements of equity are going to be revenues and expenses. And as we see here, owner capital is going to have a positive impact on equity. When owners contribute money to the organization, then the equity grows. Owner withdrawals or dividends have a negative impact on equity. Revenues have a positive impact on equity, and expenses have a negative impact on equity. Now we're going to look at some common examples of these account types. So let's begin with assets. Let's look at some common asset accounts. The first one is cash. Cash is always going to be the first item that is listed on the balance sheet. Some other common asset accounts are going to be accounts receivable. Accounts receivable is simply the monies owed to us by customers for goods or services provided. Prepaid accounts. These could be prepaid expenses such as rent or insurance. Supplies. Supplies are generally the supplies that are just used in the daily operations of the business. Supplies are a little bit different from inventories. Inventory is also an asset account. It's not listed here, but inventory is a very common asset account. Inventories are goods that are held for the purpose of reselling them to customers. Supplies are normally used within the organization. For example, office supplies. Land, buildings, and equipment. Sometimes we refer to this as PPE or property, plant, and equipment. These are the long-term assets that we use to generate revenue in the business. It might include our factories or our office buildings. Okay. Liability accounts. Liabilities are basically our obligations to others. Okay, one of the most common examples is going to be accounts payable. Accounts payable basically just represents the bills that we owe to others. These could just be daily bills to our suppliers or bills that we owe for utilities or the phone bill or the rent, things of that nature. Accrued liabilities. These are basically liabilities that we have incurred but we have not yet paid. Unearned revenue. This is when a customer has paid us in advance of receiving the good or service. We classify unearned revenue as a liability because we owe the customer work. We are obligated to perform the work or provide the good or service to the customer. Okay, equity accounts. Again, we have owner's capital, which is the capital contributed by the owner or the stockholders. This has a positive impact on equity. Owner withdrawals or dividends have a negative impact on equity. And then through the income statement, we have revenues and expenses. Of course, our revenues positively impact equity and our expenses negatively impact equity. Thank you for watching this presentation on the accounting equation and account types.